Hello and welcome. In this lecture video, I'm going to give an overview of cost volume profit analysis, or CVP. And I'm also going to talk about the contribution income statement, and then we'll look at a few high-level applications of CVP. So we say up here, once we've been able to estimate our costs, and we've been able to estimate our fixed costs, our variable costs, and then also divide or parse our mixed cost into their fixed and variable components, now we can do cost volume profit analysis. So I was saying in the initial lecture video for cost volume profit analysis that the way I think about CVP is what if analysis. So for example, we said, for Mary Washington, what if we increase advertising and then student enrollment increases by 10%? So we increase advertising costs by 8%. Enrollment we think will go up by 10%. What is the effect of this on any kind of surplus that we might have? Okay, what is the effect of this on our financials? That's what we mean by cost volume profit analysis. So kind of like what if analysis. What if we increase advertising? What if we drop the price of what we sell and we drop our unit price, and by dropping our price we actually sell more? We increase our sales volume. Does this increase our net income? So all these different scenario planning, that's what we're talking about in context of CVP. One thing that helps us with conducting CVP is to put our financial statements, our income statement, in a different format. So typically when we think about our income statement, we have our sales minus our cost of goods sold gives us our gross profit, less our operating expenses gives us our net operating income. Okay, that's what we use for external financial reporting. What we're talking about with CVP, though, is we look at the income statement in a little bit different format. And we use our contribution income statement. Okay, and with this, what we do is we separate out our costs by variable versus fixed. So we put all of our variable expenses right over here. Okay, this is variable product and variable period. So remember, product versus period cost is something that we talked about in some prior lecture videos. Product costs show up in cost of goods sold. They are expensed, i.e. they show up on the income statement when they are sold. Period costs, on the other hand, show up on the income statement. They are expensed in the period in which they are incurred. Same thing over here. Product and period. Okay? So with our contribution income statement, we're separating out our expenses by behavior, variable versus fixed, not whether they're product or period. Because remember, with our original income statement that we've talked about so far, we have our sales, we have our cost of goods sold, gives us our gross profit, and then we have our operating expenses, and then we have our net operating income, our NOI. But how are we separating out our expenses? This is product expense. These are period expenses. So with our external external income statement, we separate out our expenses by product period. With our contribution income statement, we separate out our expenses by behavior, variable, fixed. So this is variable product plus variable period. This is fixed product plus fixed period expenses right there. Okay? We do this because it helps us to make decisions, because now we can see all of our variable expenses in one place, all of our fixed expenses in one place. The other thing is that this cost of goods sold, if we return to our external income statement, this cost of goods sold includes fixed expenses. It could include some fixed product expenses such as manufacturing overhead. The problem is if we put our cost of goods sold divided by our units, that gives us our cost of goods sold per unit. Now, somebody might look at this income statement and say, okay, maybe our cost of goods sold per unit is $10. Let's just say it's $10 and we make 2,000 units. But then we want to make 2,500 units. And what would they say? They'd say, oh, 2,500 times the 10, There we go. That's our total cost of goods sold for making 2,500. Not so fast. The problem is, right, that this cost of goods sold, this total cost of goods sold number, includes some fixed overhead. So if that's true, that would stay the same regardless of how many units we make. And then what would happen to this number as we make more units? It would decrease. It would no longer stay 10. Maybe it goes down to $9.50. Who knows? Right? This is just some numbers I'm making up here for illustrating the concept. But what I do know, and for sure, is that this cost of goods sold, if this includes some fixed product expenses, such as fixed manufacturing overhead, our cost of goods sold will decrease per unit because fixed costs decrease per unit. So if that's the case, multiplying 10 times the 2,500 to get cost of goods sold at 2,500 is not correct. That way it would actually be, you would be overestimating your cost of goods sold. In this case, we can say we can put our variable expenses on a unit basis, and then we know variable expenses per unit stay constant, right? So we know, for example, if we have 500 bikes, we sell 100 in our total variable expenses for 500 bikes. That means we have $300 of variable expenses per unit. We know that if we make an additional bike, one more bike, 501, what will be the variable cost to make one more bike? It's $300. Stays the same because variable costs per unit stay the same. That's what we're assuming. Okay, so the basic point is that with our contribution income statement, we separate out our expenses by behavior, and then that helps us with our cost volume profit analysis. This idea of contribution margin is simply equal to sales minus variable expenses gives us contribution margin, or on a per unit basis, it would be our sales price per unit minus our variable expenses per unit would give us our contribution margin. You can think of contribution margin as profit or net operating income before we subtract out our fixed expenses. Okay? So then we take our contribution margin minus our fixed expenses to give us our net operating income over there. Okay? Now what we can do is we can express this on a per unit basis. So if we have $250,000 in total sales for 500 bikes, how much is it going to cost us, or how much do we sell each bike for? $500. 250,000 divided by the 500. Variable expenses total 150 at 500 bikes. 150 divided by 500 gives us $300 variable expenses per bike. Therefore, contribution margin, sales minus variable expenses, $200. How do I get that? Well, I could take my 100,000 divided by my 500 bikes to give me 200, or I could just subtract my sales price minus my variable expenses per bike to give me my contribution margin per bike. I can put my variable expenses on a per unit basis as well. I can take my 80,000 divided by my 500 gives me the 160, and then I can put my profit on a unit basis as well. Okay? Now, one of the applications of CVP analysis is to determine the break-even point. And the break-even point is the level of sales for which we have zero profit. Once we achieve break-even, net operating income will increase by the amount of contribution margin per unit. Okay? So if we think about break-even, we can put break-even in terms of units. So this would be our break-even in terms of units. And then this would be our break-even in terms of sales dollars. So if we think we're just a bike shop in downtown Fredericksburg, what we could say is we need to sell 500 bikes to cover all of our costs, all of our variable costs, and all of our fixed costs. And then that's 500 bikes. Or we could say we have to have $500,000 in sales dollars to cover all of our variable costs and all of our fixed costs. So that's the concept of break even. Now the second part says that net operating income will increase by the amount of contribution margin. So what we're saying is once we hit this point, right? If we look up here, once we hit this point, we have covered all of our fixed costs. So any additional sales, net operating income will increase by the amount of contribution margin. Okay, so let's walk through an example to really understand this in a little bit more detail. Okay, so if we say based upon the information on the prior page, what are the fixed costs that we have to cover each month with sales, and then how much contribution margin do we have to generate in order to break even? If we look over here, we have to cover $80,000 of fixed costs. Now, if you look at the way this is set up, we take our contribution margin minus our fixed costs, gives us our net operating income. So this means we have to cover $80,000 of fixed costs, maybe $80,000 of rent, for example, for our RBC bicycle. And by the way, we'll be working with this example right over here throughout most of the rest of the notes in this chapter. Okay, you have to cover $80,000 of fixed costs. That means, what does contribution margin need to be? It needs to be $80,000. If this is $80,000, that is zero, right? And then therefore that's the break even. So if we look over here, we need to generate $80,000 worth of CM contribution margin to cover $80,000 worth of fixed costs. So therefore, how much do we need to sell in order to cover our fixed costs and break even? What does sales need to be? Well, the way that we can figure it out is we can say, all right, we have to generate $80,000 worth of contribution margin, right? If this is $80,000, 80,000 minus 80,000 gives us zero. Now, what is our contribution margin per unit? It's $200. And that stays the same, right? And it stays the same because sales price stays the same and variable cost per unit, we also know, stays the same. Those two inputs stay the same, therefore contribution margin per unit also stays the same. So what I can do is that each bike I sell gives me $200 of contribution margin. I need to get $80,000 worth of total contribution margin. Therefore, I can divide my total contribution margin by my contribution margin per unit. And what that gives me is 400 bikes. If I sell 400 bikes, I will break even. Now, if you're a bike shop owner, is that something you'd want to know? Absolutely. If you are a university, do you want to know how many students you have to enroll to cover your fixed costs and break even? Absolutely. Yes, this is something you need to know even if you never want to do accounting again. You just want to run your own bike shop. You have to know this, okay? So let's look at another problem over here. Let's look at this problem. If RBC sells 430 bikes, what would be their income? So I want you to pause the lecture video and solve this problem, and then we're going to come back and check it, okay? Okay, there's a couple different ways to solve this problem. If RBC sells 430 bikes, what would be their net operating income? The way that you probably solved it was to go back through and redo that income statement at 430 bikes. And what income statement do I mean? I mean this one. 500 bikes, right? We know that the selling price is $500 a unit. We know our variable expenses are $300, contribution margin, okay? And we know that fixed costs also stay the same. So what I could do is I could multiply 430 times the $500 per bike, 215. I know my variable expenses stay the same at $300 a unit, times the 430 gives me 129. I subtract it, I get contribution margin of 86. My fixed costs also stay the same. They always still stay at 80,000. Then subtract it and I get 6,000. The other way I could have done it, this is way number one. Way number two is down here, is I know my contribution margin per unit stays constant at 200. Times my 430 bikes gives me 86,000. Minus my 80,000 gives me 6,000 net operating income. In the next lecture video, I'll talk more about the shortcut way. Thanks.